Why I like Ginnie Mae funds now, says Jeff Cosnett, this guy right here, who is editor of Kiplinger's Investment Research for Income. Now, this was written, I think, in 2020 or maybe 2019. Ginnie Mae funds now are even better, my friends, because anytime there is chaos in the street, there's always a flight to quality. Let's take a gander, shall we? Let's just look at the 10-year Treasury. Oh my, well, here's actually the Vanguard BND, the Bond Index Fund. And we look at, oh, look at that. 1 day. Price is going up. Why is the price going up? Because the stocks are getting killed. Everything's getting killed in the bond market and the investment market. You know what's not getting killed? The government bonds. Government bonds don't get killed. When everything goes to chaos, it's called a flight to quality. Everything is correlated when the markets are getting destroyed except government bonds. So the S&P 500 is down almost 2% right now. Everything is getting destroyed. Not government bonds. And what is Ginnie Mae? It is a government bond. I'm telling you right now. The Ginnie Mae mutual fund only trades at once a day. But yesterday, in the sea of red here, check it. We got lots of red. Oh, what's that green thing? What's that green thing? Oh, it's a Ginnie Mae. Yesterday is up 0.42% yesterday. We won't know the day what it's going to be up today because it's still in trading. It's one drawback on mutual fund. You don't know how they end the day until the close of the business. But I can't guarantee anything. I highly suspect this fund will be up pretty significantly today too. So this is before all this craziness. My man Jeff says, in these unpredictable times, any combination of high safety and fair income should deliver extra value. Right? Let's see. So what can deliver above inflation income and still protect your capital? It's time to rediscover a sometimes overlooked and underappreciated investment. Ginnie Mae. Yes, ma'am. Or yes, sir. Ginnie Mae is a government National Mortgage Association, which is not an association, an agency, but it's actually a federal agency. Or association or a government GSE enterprise. Excuse me. It's not an association or an enterprise. It's actually a federal agency. It's literally a federal government. So that satisfies the safety requirement. Ginnie Mae's cannot go bankrupt. By law, Ginnie Mae's are 100% guaranteed to pay back its principal. This isn't debatable. This is not debatable. Ginnie Mae's are government bonds. And when things go south, government bonds go up. I mean, could that always happen? No, I don't know. But if you look historically, it has. All right. The question is whether the income is enough to match or exceed any possible erosion of the principal if mortgages lose value or higher rate loans are refinanced in such numbers that fill up with lower rated debt. So basically what he's talking about is saying, hey, right now we're getting a 4% yield on your mortgages, but then people go to refinance once the interest rates go down. So instead you're getting a 3%, and that's called prepayment. Not a prepayment penalty, but it's just a refi, man. That's all there is to it. You're getting a 4% mortgage. You say, I don't want that 4% mortgage. I want to refi at 3%. And so the issuer of Ginnie Mae, the federal government for which you invest in, says, we have to close that 4%. Instead, Josh, you're not getting 4, you get 3. All right, well, that sucks, but I don't think anyone's expecting interest rates to go down anytime soon. So now we say, okay. However, current lodestar is rising, not falling rates, and that suggests that the standard bonds such as the 10-year Treasury are in more jeopardy. Yeah, if a mortgage this week closes at 4, wouldn't that pile of 3% loans lose value? Yes, because you have mortgage rates going up. No one's going to want to buy the 3% at the same price. Well, that's a drawback about bonds. However, the mortgages as a portfolio retain their value better than ordinary bonds. 100%, man. If the 10-year T-bond yields really do go from 1 to 2, if they really go from 1 to 2, yeah, okay, more because mortgages have a limited lifespan, whether because a home is sold or a note is prepaid. Ginnie Mae securities have a much shorter duration than treasuries. Yeah, absolutely. So people refinance their mortgages, they pay off their debts. They sell them, they move the whole thing. And Ginnie Mae's, while they're backed by 30-year loans typically, very few of those 30 years are set to maturity, just very few. I'm not all that worried about interest rate spike, I'm just not. A rule of thumb that let's see, we're going to talk about duration. It's okay to think of Ginnie Mae as a substitute for cash or ultra-short bonds, but Ginnie Mae funds' historical returns are not totally cash-like. Vanguard's 5-year annualized return of 3% versus the Ginnie Mae versus the ultra short term bond fund 1.9. The Ginnie Mae's this is again 2 years or so. I'm not going to read that, but I mentioned the Vanguard fund for reference. The other providers offer more alike than different, offering a yield close to 2, but I don't know what the, actually, let's take a look what the yield is right now, shall we? Let's go 1 sec. Here's the Ginnie Mae 30-day SEC yield is 1.1%. You know, it's not 1%. It's a fund that's losing money. And the Ginnie Mae right now is not. Now we can look over 5 years. You can say, oh my goodness, look, Josh. I'm not sure which one's the Ginnie Mae's in dark blue. Is that 10,000? Now it's at 9,850 in 6 months' time. Oh my goodness, I've lost 1.5% in 6 months' time. Ye with little faith. Ye with little faith. Let's see, 5 years. Oh, look at that, 10 years. Look, we're not making much money. I get it. That's the whole point. Look, and so far this year, we're down 1.72%. I mean, you're not going to make a ton of money in Ginnie Mae. But as a barbell strategy, in my opinion, it's the best thing there is, without question. I love Ginnie Mae. I've been saying this for years and years and years. All right, so here's the distribution yield, trailing 12 months, because that's when interest rates are lower. Interest rates go up, go 1.05. You're going to see a higher rate, but you're going to see initially decline in share price. I mean, let's look at BND, see what this puppy's doing. What's up, baby? Remember, BND, the total bond market index, 70 to 75% are treasuries or government-sponsored government-sponsored entities. That's what it is. Enterprises, entities, something like that. So let's see right here. You're going to have 1.82 SEC yield for 30-day yield, which is what matters. The price is up 50 basis points so far today. It's up 0.5%. Not too shabby, if I do say so myself. What was it? Yes. Let's see. Hey, buddy, come on. Hey, you. Here, Pablo. Historical quote. Price. Look at that. Price change. Why do you think that happened, my friends? You want to take a guess? Because anytime there's blood on the street, that's what happens. All right. Well, I wonder if we can go to long-term corporate. Let's just see what this guy's doing here. We'll do a spider. Long-term corporate. I have no clue if this has gone up or down. I don't know. Let's take a gander here. Imagine, it's gone up too. All right, so corporate bonds gone up. I'm surprised by that. I thought that gone down. We'll see once the liquidity stops if that goes up. Let's go PFF, the preferred income. This is my preferred stock fund, which I like. And that went up too. I'm surprised. Wait till the liquidity dries up. When the liquidity dries up, those bonds will get smoked. And I'm not saying there will be a liquidity drying up, but you never know, man. That's what's happening in Russia right now. The liquidity is drying up and their bonds are going to get destroyed. All right, that's why I prefer Ginnie Mae. Couldn't have said it better myself. Love to hear your thoughts. See ya.